Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Cargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the
Excellent.
disclaimer. Yep. I'm going to share my screen. And while I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read them back to me. And to give you guys a couple minutes to type in those questions, we'll start out taking a look at the pre-market report, see what kind of insights we could get from the pre-market trading, and then we'll move on to the questions. All right.
Perfect.
So pre-market report. These are stocks trading in pre-market hours. Up top, we have this calendar view, and this calendar does allow you to go back in time if you wanted to see what traded in pre-markets in history. Today, we're on January 17th over here. And so far, from the high level, this is what's going on. We have 208 stocks trading higher in a pre-market, 658 stocks trading lower. As far as volume goes, we have 246 million shares trading on up volume versus 127 million shares trading on down volume. If we convert that volume to dollar value, we have $587 million worth of stock trading higher versus $3.5 billion worth of stock trading lower. And from this perspective, it points to a more bearish bias in the pre-market trading. Let's move down and take a look at the pre-market from a couple more perspectives, and then we'll move on to the questions. So I'm going to scroll down, and now we see a list of stock symbols trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers in the pre-market, and biggest percentage decliners. I'm coming down here and I see 41 stocks made our biggest percentage gainers list. 198 stocks made our biggest percentage decliners list. And to make this list, we do set certain thresholds regarding price changes, volume, liquidity, and so forth, because things in a pre-market are less liquid. And if you notice, besides our liquidity measures, we do pretty much any security that's listed on the major U.S. exchange can make this list. So it can be an ETF, it could be a low cap stock, a preferred stock, it could be a closed-end fund. And to narrow down this list, we could use the filters here above to narrow it down to a smaller group. But I didn't forget to mention that just from, these biggest percentage gainers versus biggest percentage decliners, that also indicates that so far the traders in a pre-market are leaning towards the bearish side. But let's narrow down this list further. And if you do have a watch list, if you save your watch list, you can filter by your watch list using this filter. I'm going to use this filter in ETF. And when we click on it, you get a drop-down menu to select from. There are different ETFs here. We're going to choose this one, SPY. Click on that. And when you do that, the list below gets filtered by stock symbols that are holdings in the SPY ETF, which are the S&P 500 constituents. And here, none made our biggest percentage gainers list, but we do have 38 on our decliners. So from this perspective, it also looks like traders in a pre-market hours have a bearish sentiment or bearish lean. We'll give it a couple minutes. I'll take some questions now if you have them.
Yeah, nothing's popped up yet, D.
Okay. Let's then move on to, I'll go to SPY. This will be my default symbol when there are no questions. And, I'll go over some questions that we get over the emails. So some of these questions I do answer over the emails. However, let's cover them here. These are things that other people have been asking. So we'll go over that. I'm going to go to the options chain here for SPY. And when you go to the options chain, let's come out. I'm going to select an expiration that, has a little bit of time to go here. So let's just go like to January 26th expiration. And, over here, this options chain, it's organized by different calls and puts and strikes. And what we're looking at is the prices for each of these securities. And one of the things when you start to do an analysis on these options is you want to have some kind of benchmark to evaluate, are these options relatively high or low, or even if you create a strategy where you have multiple legs, how do you make an analysis, how far away the market prices are from a theoretical value or a historical benchmark. And a lot of people do that, like, let's say, when they look at implied volatility rankings, right? But the implied volatility rank doesn't really tell you how much a particular option or strategy deviates from its norm. It just gives you kind of a general index, a 30-day IV, right? So it's basically following a general index where implied volatility, if there was a 30-day constant maturity option, right? If because we have to create a synthetic one because we don't see one every day, a 30-day constant maturity option. And we create an index that tracks a synthetic or created 30-day option, and then we monitor if the implied volatility is moving up or down, or what ranking is the current implied volatility relative to historical levels. However, that doesn't necessarily mean that every option on the board fits into that ranking or that level, because options are different maturities, different strikes. And as you could see here, if I'm looking just at the different expirations, these are the different expirations now available in SPY. And here are the at-the-money IVs. Well, the at-the-money IVs from one expiration to the next are different, right? They vary. You could see right now they're upward sloping, so we have an upward sloping term structure. And if we look across, now I'm on January 26th, the implied volatility of each strike is different, right? As I scroll up and down. And just following a 30-day IV is not enough, because when we look at all these options available, they all have different implied volatilities. They don't all conform to one implied vol. And that's why we tried to then go further and analyze particular strategy setups for a particular option. So let's use that one as an example, and let's just go to I'm going to just do this 475 call. And when you click, oops, hold on a second. Now I got an error. Let me refresh my screen. and just make sure that's not a bug. All right, so I just found a bug there that I have to fix. So let's go over here, the 479 call. And here, by selecting this, now I have this analysis box here. The first leg, and we'll just start with one leg, is the January 26, 479 call, $1.96. I'm going to calculate that. And then when we run a calculator, it's going to bring this up initially, payout diagram, which just shows what this strategy, a basic strategy, just long a call, what this looks like at expiration based on different stock prices. So these are different potential stock prices. In this graph here, if you hover over, it will show you the profit or loss at each level. So you could visually see where this call, stands to make or lose. And it's using an option profit calculator. However, in a world of options, there are different possibilities, different potential outcomes. So we tend to draw it out in a graph, right? So there's not, we can't just use an option profit calculator to give it one price, unless we're certain that that's going to be the price at the end of expiration. And that's why we use a graph to visually see the where this strategy stands to make, to lose, or break even. So the question that I had were these two tabs: distribution theo and IV theo. Okay. Now that we're analyzing this strategy, and we see where we could profit, where we could lose. Question is, well, is this a fair value that you're $1.96? I don't know where the stock is going to end up, right? That's the risk. That's the uncertainty. We don't know if it's going to, if SPY will be down here or up here or anywhere. We don't know which price it will end up at. But if we were taking on this strategy, then whatever this graph looks like, that's the outlook we should have, right? Because if your outlook is different than what this graph is, then you need a different strategy. But let's assume that this is our outlook. We're very bullish, and we think that this thing, it's good. It's going to go upwards. So the next question we'll have is, think like a business person or a bank, making an investment decision. So now you're going to commit capital to some kind of a risk asset with uncertainty in the future. And so what would a business person or banker who's lending money maybe to a business person, what else would they want to know? And what is the most common thing that in their evaluation is an appraisal of your investment. If you're going to invest in and buy business, well, before I pay for it, I need an appraisal. How much do I think it's worth? You need some kind of model to figure that out. Or if you a bank lends money, right, to a mortgage or to a business, or it lends you money to buy a business, a piece of machinery. Well, they want to know, what is it worth, right? How much what is this piece of machinery potentially? They get an appraisal. This is the most common basic evaluation in any financial, investments. And we know what the market value is. That's not the problem. The market value is something we could observe, right? Just like this is what it right now. We know what price it's available for sale. So we know where the market itself is. We need to figure out, well, what do we think it's worth if we're making this investment decision? And there's no one right answer, because you could use different models and inputs, and maybe the situations can also change, and you would apply different inputs or different assumptions. So we're going to start out with some basic benchmarks, right? We need some baseline to start out with. And we're going to discuss these two, the differences between these two. So the first one looks at the distribution of returns. And what this model does is say, okay, I don't know if the stock's going to go up, it's going to go down, or it's going to stay unchanged. I don't know. But historically speaking, based on the stock behavior, right, what is the probability of this option being profitable or unprofitable? And what is the average value of a similar option at the end of this hold period, right? Because we do know that, hey, there's 8 trading days left in SPY. There are 10 calendar days, but 8 days of trading. And that's what the risk is. We're holding this security. It's an option that expires in 8 days. So after 8 days of trading, what is the on average, what would a option that's 0.9% away, on average, what is it worth over the long term? In other words, we know sometimes it's going to be zero. Sometimes it could be worth a little bit more than zero. Sometimes it could be worth a lot more. But on average, in the long term, historically, what was it worth at the end? And this is using actual stock price returns. Okay, so we'll say irrelevant what it is today. If we didn't even see these options, right? If we had no idea, all of these were blank, and we wanted to know on average, historically, what would a similar option be worth? We'd have to run it through some kind of model and assumptions. And using historical data, this is what the distribution theory is saying right now. And you could change these assumptions. It's saying go back in history, look at 4 years of history. These are changeable. And furthermore, let's narrow down our data and say, let's use 4 years of history where the implied volatilities were, narrowed down closer to where they are today. So right now we're in this kind of a subdued implied volatility regime. So let's look at that and take out, where the implied volatilities are high and so forth. So you could change this. This is just the default setting. All right. So based on that, you could see here we found 63 observations historical. So if I click on this view, they're over here. So this is the date ranges. This is where the implied volatility was, the 30-day IV at the time. And this is what the stock did, this percentage moves. And based on these percentage moves, we'll say, well, that if it replicated the same percentage move, then the stock will end up here or here or here, right, from today's price. And then we could calculate then what would the end value of this option, the 479 option, be. So doing that exercise, we'll say, what is the average value of all these options? So you could see here there's zeros. Sometimes there's a big move, 3.6%. So that's $13. If we took the average of all these observations, we came up with $2.67. So, from that perspective, that looks like, okay, well, $1.96 is not, that doesn't seem way unreasonable. because over the long term, the average value was even higher. What else can we see? Well, the next question is, okay, we do see that there were a lot of zeros here, right? There were a lot of zeros. I'm just looking at the first page, but I see a lot of times it was zeros. Sometimes, the stock went up, here 1.1%, but that wouldn't be enough, to cover the cost of this option, not 196, because that would have implied that this option is worth $1.13. Our next question would be, okay, well, how many times out of these 63 did the stock move enough by a big enough percentage to cover this 196? So that's this one. That's the one. That's the percentage of times in our historical observations that this, in theory, this option, from the buy side would be a winner. Okay. And the theoretical edge is just the difference between these two. So that's the win rate. This is the standard deviation of the returns. And this is the probability of touch. And this probability of touch is looking at the historical data, and it's trying to answer another question. If, with 8 days to go, if we just measured the full 8 days, 31, almost 32% of the time, the stock moved enough to cover the cost of this option. Okay. But that's ignoring everything in between. That's looking at the start date to the end date. That's it. It's looking at one return in this date range from the start to the end. If you held it, if you did it, closed your eyes, forgot about it, and came back at expiration, that's what that is this calculation. However, we know that the stock doesn't just stay closed for 8 days and then open in the 8 days at a new price. That's not how the stocks move. There's continuous trading. There's trading in between. And when you have 8 days, the stock could have volatility where, it could be higher or lower. It doesn't necessarily at the end of 8 days, it doesn't have to close at the highest level or lowest level. It could be it could close at an unchanged. It could be at the same price, but experience a lot of volatility in between. And perhaps within that 8 days, the stock a lot of times could reach levels that would have made this option, in the money, completely, covered the cost of that premium. Well, how many times that happened? That could be another question. Is it okay at the end of 8 days? Maybe it's 31%, but based on its volatility, how often does it even cover that at any point within the 8 days? And that's what this is. Probably it's at 60%. So 60% of our historical observations showed that SPY at some point in time out of our observations, at some point it increased by enough to in theory make this to cover this option. Okay, that's what this is saying. That's the problem. It needed to move above 1.3%. All right. So let's go to the next one. Now, remember, this is only looking at stock prices.
D?
Yeah.
We did have a question. We can get to it later. I just wanted to wait for you to come up for air real quick. But we had a question from Anshu, who's a new user, and he was asking about he really wants the feature. He's looking, I think it's the new feature where you can identify the busiest spreads that are trading.
Yeah.
He wants to identify the busiest spreads. Rob's given him a lot of options to kind of work through the site to kind of find it.
Yeah.
Uh, what is the best way, and maybe when is that new feature going to be available, I guess is the question.
Yeah. So that's a good question. We do have, and that we're working on that. And unfortunately, what we're trying to work around was that, particularly actually in like SPY and NVIDIA. And we ran into there's so many spreads that we ran into issues of performance. And once I publish it, and we will probably, I'm looking at, like, right now, I know it'll be a bug if I try it, but if, if we publish it right now, we already know that there are going to be bugs in there, and it's going to impact the performance of for everybody, right? Because once the bugs are hitting the servers are going to slow down, and that's what we're trying to do, is work that out where we get the performance more efficient, because some of our symbols like SPY, NVIDIA, Tesla have a lot of multi-leg trades. And we're looking at different techniques, right, to capture it and analyze it. When we look at the multi-leg trades, what we're doing is the tool that you're describing. It's compiling the data, isolating the multi-leg trades, but then there's a software logic that and reasoning that goes behind it to identify the strategy. Okay, so the identifying the strategy is the harder part, because isolating the multi-leg trades is we could do, but then we have to take the multi-leg trades, combine them, say these are the related ones, here are the legs, here are the prices, here's how it traded. So what do we think? What was the strategy? And and then make those interpretations. And that's the hard part. And especially where there are a lot of them, like SPY. And I'll show you guys once we bring it up why we were having so many issues, is that, when you're looking at data, it's not always very clean. And because it's not very clean, you start getting these weird errors. And we started noticing them where it's very busy because you get a lot of data. It will come out, but it's not available yet. But you can, if you go just under the options volume, if you just wanted to see where there are a lot of multi-leg trades, you could screen them out from here. So if, like, let's just say I wanted to screen out, where option volume was, let's say, more than 10,000 contracts, right? And the multi-leg trades represented 80% of that volume. So now I got 7 stocks where you could see DKS. Yesterday, I'm going to switch to volume, traded 19,000 contracts, and 88% of those were multi-leg trades. So you could filter out where it's happening. However, the interpretation of that is what so far we've been having issues. Even when we've resolved one issue, we're still seeing that we need to keep cleaning it up. Until we clean up all those issues, we don't want to push it out, because we already know there'll be bugs.
No, it's interesting. I mean, then you could even go and, like, our landing page. I mean, we don't talk about the landing page maybe often enough, but there's a whole alert section, and you can manage alerts, and you can screen by the symbol, so you can see if it showed up, see if any trades showed up as alerts that may give you some more information as well. So there are ways to go through it and kind of look at different trades and what they may be showing and kind of dig through, see if it's anything that's interesting. Awesome job, buddy. We're right up against the opening bell.
All right, everyone. Thank you for joining. Thank you for the question. I guess I stopped. I didn't fully go over those other features. If we have time tomorrow, I'll continue on that.
No, let's plan on doing that tomorrow.
Yep.
All right. Awesome job.
Stay safe out there. Have a great trading day. Yep.